Morning, everyone. This is Sid Jane.
Hi, I'm Tyson Halsey, and I'm going to talk about the Great Rotation, the the case for gold stocks, and Batey's Gold Mining Investment Opportunity Fund. And we have this is our monthly call, and we got a couple people missing. We've added Sid Jane, who will speak on gold and crypto, and a little about a quant software, and Mitch Belagic. Uh, anyway, I'm just going to go ahead through my presentation, and then Mitch, and then Sid Jane, followed by uh, Chang Q and Charles Zhang. So I'm not sure. Does everyone see the Great Rotation?
No, you're not.
Okay, I'm going to try going back and.
Okay, here we go.
Okay, so um, in my investment experience, which began in the 1980s, at least professionally, and my study of the markets, I think that this chart is very valuable to understanding what's going on in the market now and what's gone on historically. And I think that there is a argument that there are inflationary and deflationary periods, and during those inflationary and deflationary periods, you have different market leadership based on the fact that either you're having declining inflation or real rising inflation. And these periods often are marked or commence after a major peak like 1907, 1929, 1970, the 2000 peak. And I think now equities are peaking and we are beginning a new inflationary market and or inflationary cycle. And I think that gold, oil, emerging markets, the dollar is weaker, and the S&P 500 tends to underperform in these periods. And I think that uh, that is what we're going to see going forward. I've shown this before. I'd run a tech hedge fund in the 1990s. I got out at the top. Mitch Belagic was an advisor to this fund at that time. And we're up about 112% in 5 months. It was a fast moving market like it is today or has been. But what really was a big mistake was not turning around, looking at valuations, and looking at where to rotate. And with hindsight being 2020, I can say I should have been in gold and precious metals and the emerging markets and oil and energy and small caps and value stocks. And I think that that's a similar message today. And one of the reasons is I think that the market's overvalued. I think the Fed risk premium model is a very credible one. We're trading at with very little premium. I was talking to one person who says it's negative by his model, but basically it's saying that you are not paid. The market is so expensive, you are not paid to take the risk to be in the stock market over just being in a 10-year US Treasury. And I think there's something also reminiscent to the 2000 bubble, where you have mega cap stocks that have gone parabolic. And we've kind of had a second boom here. And when you look at the size of the market capitalization of the Mag 7 relative to GDP at 62%, it seems to me that the growth is fully priced in and you have to be careful. Um, Technically, you've had a breakdown in momentum, and in fact, you got a death cross. And while I know that not everyone buys technical analysis, it does kind of tell you, where money is flowing. And next week we should get earnings out of Nvidia, and I think if those earnings are disappointing, I think that Nvidia could go down, and it will take the whole market down with it. I'm not trying to make a fundamental prediction, There's a great deal of growth in AI. People have talked about it, but I feel it's fully priced in. I think that my philosopher George Santayana said, "Those who cannot remember the past are condemned to repeat it." And it's fun to sometimes overlay charts. And if you overlay the chart of Cisco and NVIDIA, they look terribly similar. And NVIDIA has basically been going sideways for about a year. But Cisco was a stock that was up 8 or 10 fold in the late 1990s, and then it dropped about 80%. But it continued to do well. It continued to dominate. Um, but the multiple collapse, the earnings deceleration, knocked the valuation in the stock from a bubble territory to something more reasonable. And I think you have that risk in NVIDIA, and people think, no, you got to own NVIDIA because they're the leader. We will see. Nokia was a stock that I was involved in the 90s and did very well, but then also they really had some stumbles. And I think that we will see what happens. I'm not sure whether the Chinese are going to give NVIDIA a run for its money, but I feel like it's overdone. And historically, it feels like it's a bubble. I also am cautious on the bond market. I think that we've enjoyed a golden age of investing, and the 60/40 and 10-year treasuries declined from 15, almost 16% to a 0.5%. They've moved up. And this week we had a little difficulty selling our bonds, and we have inflation risk. There's duration risk on a 10-year treasury getting 4.5%. That's not really exciting to me. I'm not sure we know where interest rates are going, so I don't think that's a good bet. This is kind of interesting. Rich Gula, who's not on the call today, had pointed out that there has been some stealth easing. And why that is, I'm not sure, but basically the Federal Reserve bought something like $43 billion of U.S. Treasuries over the last 2 weeks, while we had this great run in stocks after Trump pulled back on the timing of the tariffs, and the stock market, responded, and we were down 20%, then up 20%, and now, and the Fed was buying bonds, which is sort of a easing move, and so things have been very favorable. But at the end of the day, I think that the lesson that I learned is that I think that we are rotating away from mega cap tech, the capitalization weighted indices, and you can see that this year foreign stocks are up 14.7%, 10% for emerging markets, and where leadership has been for the last decade or so in the S&P 500, the Dow, the NASDAQ, it's not there. And I think it makes sense. And I mentioned this last time, but I think it's worth reiterating. The value of rotation. They always say diversify and don't market time. And I think that makes sense. But frankly, if you wanted to make the most money, you had to have been in all the Magnificent Seven stocks for the last 15 years. But now I would say you want to get out of them. And Mark Mobius, who's worked under John Templeton, brilliant emerging market guy, saw him speak 20 years ago. He said, the emerging markets can get really clobbered. They can go down 90%. But if you buy them when they're down 90%, if that market comes back to where it was previously, you've made 10x. And all you need to do is have 10x in your portfolio, and that cures a lot of mistakes. Bob Arnott, who worked with Bill Gross at PIMCO, recently was saying on Bloomberg that if you had stayed in the NASDAQ 100 or the NASDAQ from March of 2000 to March of 2002, you would have been down 50%. But had you put it into small cap value, you would have been up 53%. And so that is a 3x differential. And to explain that, if you're down 50%, you got to make 100% to get back to even. And then if you're up 50% on that 100%, you're up 3x. And 3x in a portfolio, that makes a hell of a difference. And that these argue for moving into emerging markets and moving into small cap value. Um, I think that one of the great values that is not realized right now is in the gold mining space. And this is a chart of the Van Eck Junior Gold Miners ETF, GDXJ. And it's down from in 2011, it's 174. It's now about 63. You're down about 66%. It's down 66%. And gold prices are up 80%. That doesn't make a lot of sense. I think that there have been environmental concerns, a lot of criticism of mining, and but I think that this chart suggests one, you're getting a bottom here, but we've seen gold prices clearly do well, and they continue to do well, and they will drive higher earnings in gold miners. And I think that there's a case that is growing to be in gold. A lot of people say you don't want to be in gold, doesn't pay a dividend, yada, yada, yada. But the way things work on Wall Street is momentum is a powerful, is the one of the top factors in quantitative modeling. And so just by virtue of gold going up or gold miners going up, you'll see more people put money into those, allocate into what's working. And there are some fundamental cases that make sense as well. One is gold is an inflation hedge, and we're seeing inflation. There's de-dollarization. There's the idea that the BRICS want to be trading away from the US. So being in gold makes sense. And now you're seeing smart people like John Paulson say it could go to 5,000. At Denny saying 4,000 this year, 5,000 next. There's a Mar-a-Lago Accord argument that we want to increase employment or good jobs in the US by increasing our manufacturing base, which had been largely offshored for several decades. And to do that, if you lower the dollar, maybe not collapse it, but eases off, that would definitely be very positive for gold. And it is in Donald Trump and Scott Bessent's, I think they're much more tolerant of it than people recognize. So those things augur well for gold. And this chart shows the price of gold, the S&P, the GDX, which is the gold mining ETF, and the GDXJ, which is the junior gold mining ETF since about 2004. And what you see is gold has outperformed all of them, followed by the S&P. But there are periods from 2011 when gold peaked. You wanted to be in the S&P 500. Now, more recently, you want to be in gold as opposed to the S&P 500. But the thing that to me is the real value opportunity is since 2011, gold miners and junior gold miners have underperformed quite appreciably, especially given the fact that gold prices have gone up. Here's a chart which I got from my friends over at Crescat Capital that just shows the ratio of gold to the S&P, and it appears as if that ratio has bottomed and it is reversing. And the opportunity for gold, the case for gold, is that people are overweighted in these mega cap stocks, and we're moving into a commodity cycle. And one of the we're doing this strategy that we are offering to clients called Batey's Gold Mining Opportunity, and we are looking to try to make 10x over a 3-year period. And one of the ways of doing it is buying some of these small miners that have recently gotten their license. Blue Lagoon is one. We have another on our radar called ES Gold. And if you can own a company that has certain assets, but suddenly they can actually start selling those assets, the value goes up quite appreciably, somewhere on the order of 5 to 10x. And although I've not done the work that I want to do, and I promised my friend Alan DeLugash I will do better, but the management has not given me all their costs on their operating model. But I've done a general assessment of what the potential is for Blue Lagoon, which is a stock that we bought quite a bit of for our clients and in our strategy. And bottom line is they say they expect to start mining 100 tons per day starting this July. By the way, I'm going to British Columbia to visit those mines and to be at the gold mine opening ceremony. I'll be meeting the geologists at Crescat, also for Blue Lagoon, and also Peter Epsick, who runs Nikola Mining, which is the smelter that will be processing the rocks that come out of the mines that Blue Lagoon is going to be mining. But the calculation is, I think it could be somewhere. They estimate they'll extract 15,000 ounces, and given where gold prices are at 3,300 and AISC of around 1,600, or you can use 15,000 ounces. I could see the stock at about $1.60. And the stock previously was at 142. This is for the US ADR. The stock trades around 60 cents in Canada, and it was at 210 there. I think you multiply by 0.72 to calculate into US dollars. But from where the company is now at about a 50 million market cap, I think that getting to $1.64 over the course of $1.60 over the next year is quite possible. That's a quadruple. But I think that what they're looking to do is continue to do more drilling, to infill drilling. They've identified 15 veins. They've only really evaluated 10% of the property, and it's a 9-mile by 9-mile plot, 50,000 acres, where a lot of people have previously done mining, and it's a historically a good gold mining area, British Columbia. And I think that once they get a second mine open, and if they do have what they believe could be 1 million ounces of gold, this stock has a more upside past $1.60. And if they put in a second mine in a richer gold area, and they discovered that in fact they do have on the order of 1 million ounces, I could see this ultimately being a $4 stock. New Gold is one of the names that's broken out. Well, it's a name that we like, and clearly it's got a 4 billion market cap. And I read the last earnings transcript, and 3 of their major projects should have volumes up 75%. And if volumes are up 75%, and if the price of gold is going up, not only are your earnings likely to be up 75%, which would suggest to me the stock will probably double. I think it could go further. One of the strategies we're doing is, I used to work on an option floor, and I've studied a bit about options and run a couple of hedge funds that are focused on derivatives. Long-term call options tend to be undervalued, and you can buy long-term call options on New Gold. You could also do it on Agnico Eagle Mines, which is also a great company. But to me, New Gold really read through to suggest very strong earnings growth. And, so I'm pretty optimistic. I know it sounds wild to suggest that you can make 10x, but if the sector is moving and you're in the right stocks and you're using some leverage, or a company is going from being a resource company to a company that is actually cash flowing, generating free cash flow, and has a good property, I don't think over a 3-year period those are unfounded hopes and aspirations. But lastly, I know Crescat Capital put this together, or Tavi Costa over there, and basically suggesting that the cash flows that they're modeling have soared significantly past where the price of gold miners are on the Philly exchange. And for that reason, I think that while everyone is looking for the next AI superstar, I really like the idea of being in a sector that is historically cheap, that has good momentum, or that whose momentum is increasing, where gold prices themselves are rising. There's an argue that gold could go a good bit higher, but I think there's a very compelling case that gold stocks could move appreciably higher. This is me. I'm going to stop the share. I'm not sure. I'm seeing some stuff pop up on the chat. But any quick questions, or we're going to go on to Mitch Pelagic, who will speak for 10 minutes.
Well, one of the chats was mine, Tyson. Just thumbs up on Blue Lagoon. It's up 400% since January 1st.
Thank you. I'll take all the accolades because I don't always pick them right. Mitch Pelagic.
Hi, everyone. Can you enable sharing, Tyson, please?
I can, and I should know to do that right away. Hold on a second. Okay, you should be enabled. Are you good?
Yeah, just give me a second.
Okay. So Mitch has worked at a couple well-known hedge funds, Elliott Associates, a quantitative guy. He's spoken here several times previously. And he's going to give you his impression. But bottom line is, I'm leery of the stock market here. I'd be moving money away, and obviously, like gold stocks, it's one of the places where I think it makes sense. All right, we're looking at a chat. Now we're looking at a chart.
All right, so this is what's on my mind the last week or since our last call. Starting with the dollar index, like all the tariff talk and the new Trump policies. One thing that really caught my mind is the dollar, and there's two things that Trump administration is trying to do is lower the interest rate and weaker dollar. The interest rate, I'm not going to touch that because I think that's a much broader challenge that I don't think they will succeed in. That's a different subject. Dollar is very interesting because the question is, if you look at the dollar index, always the question, well, why it's not that strong? It's pretty much at its median price if you look at the index itself. But I noticed Scott Bessent mentioned a few times in his discussions about real effective exchange rate of the dollar. Okay, so this is the logic that they're listening to. What is this exchange rate? It's the Calco Banco International Settlement. It's the weighted average of the dollar bilateral real exchange rate against a basket of trading partner currencies, adjusted for relative price of cost difference. This is what's on his mind. So if you look at here, the Nixon debasing from gold was at this index around 115, then the Plaza Accord 115. We're there again. Based on this kind of adjusted dollar index, it makes sense. And if they have a Mar-a-Lago agreement, it will happen. I'm usually a dollar bull, especially when dollar falls and we are at the cusp of some kind of economic or geopolitical macroeconomic crisis. I'm always a dollar buyer. But not anymore, because I don't want to get caught at this Mar-a-Lago and seeing the dollar maybe at this scale go down to 80, which would probably translate at about 75 or 80 at the dollar index as we know it today. So we're talking about that could be a good 20 to 30% devaluation. Might not happen. They might not succeed. I'm saying that's what they're trying to do. So that brought another thing is like I'm kind of looking at the whole spectrum of this whole global trading system. This is a report that I'm citing. It's very useful. I'm going to attach it here. Hudson Bay Capital, very good report, at least in my view, and aligned with my beliefs. I will attach it here if anyone's interested, take a look at it. But the bottom line is I was really impressed by their recommendations, implications. First of all, their belief that the whole tariff thing is as we all know, is really directed to China, and they feel that the bottom line is going to be a 60% tariff on China and pretty much nothing or 10% to the rest, which makes sense. That's exactly what Scott Bessent was also mentioning as the golden middle between embargo type of tariffs versus unacceptable low tariffs. So there's a good possibility that this might really happen. I believe that this number of 60% could be real. And generally, that's one of the things that caught my attention. Implication for markets, I fully agree. Is it disinflationary or inflationary? A lot's going to depend. It is inflationary, but a lot's going to depend on the dollar. And if they actually really want the lower dollar, inflation is going to be rampant. And do they care? Some people say not in the long run, because that's a good way to get rid of the debt just by making it like totally valuable down the line. And this is a very important fact, and I know this as a trader. Financial markets are likely to react more strongly to currency volatility than the tariff themselves. So watching the dollar and these potential Mar-a-Lago Accord and whatnot is going to be the driver of the market, in my view, more than the notes and the bonds. Although, if we do get flashes of the 10-year going towards 5, then we're going to have both things in the focus. The latter definitely not good for stocks. Now, I just want to go very quickly to a second subject. I cover a lot of AI, and so one of the overlaying topics with AI and Trump's economic policy is AI-driven manufacturing versus traditional reshoring. And these are some notes I took. I can share if you're interested. This is where I totally have disagreement. There's no way in your wildest dreams that we're going to get manufacturing jobs back. Okay, maybe Trump is still living in the 80s or 90s, but this is a different environment. We cannot get those jobs back, and the future is not in that anyway. So if we are competing against China, China has two edges in this. Their AIs, we have a technology AI battle with China right now. But China has a manufacturing base, a supply chain, logistics, manufacturing that we don't. So we're definitely behind the curve. We do have a big advantage in energy. Industrialization relies on cheap energy, and that's our edge. So in my belief, the two things are going to happen. I think the future of the U.S. manufacturing is not traditional reshoring. It's high-tech and AI coupled with really cheap energy. That's the ticket for really industrialization and competition with China. Anything short of that, I just don't believe it. So those are the 2 points. And then comes to the next subject that I've been talking a lot about. And actually, let me just flash. This is the report I did a few months back on industrial automation. So I was looking at why am I a believer in industrial automation? It goes hand in hand, AI manufacture versus manufacture reshoring, is because in this whole AI cycle, we're slowly moving into the industrial robotics cycle. It's been around for decades. It definitely accelerated, and it's a question of supply demand. When supply comes up, like big manufacturers coming up with robotics, automation tools, and whatnot, the bigger question is who and how long and at what rate are going to be adapted in the industry. And I'm seeing that trend probably the strongest in the AI sector this year. It's going to be implementation and first fruits of the labor of adapting AI into robotics. So it's not traditional robotics, it's smart robotics. So I outlined here some best in class of US and global stocks, thematic ETFs that are good to follow, and then top small cap innovators in industrial automation, smart manufacturing, which have two benefits to their large cap and enterprise counterparts, is that they have been lagging, and any kind of breakthrough in this sector, which I'm expecting to happen in the next 4 years, starting with this year, they will have a much bigger bang for the buck. And that also brings me down to one of my favorite stocks, that's Alibaba. So if you understand now building products for AI is one thing. NVIDIA's and Microsoft's and whatnot, that's fine. That's a sexy subject, and that's what we follow. But it's really, that's built so we can actually have a better growth and better industry. So implementation of AI in Main Street is the key. And the reason I like Alibaba a lot, because besides that I like Chinese tech versus US tech as a spread trade that I mentioned before, Alibaba's in the best of both worlds because they are supplying and they are the demand. They're implementing this in an incredibly high rate into their operations and development, but they're also creator. They actually supply and build cloud products in AI as well. So they're actually one of the few stocks or sectors you'll find that are actually beneficiaries on both sides of the scale. And here's exactly the trade that I'm still in and I was looking at. Comparing here the triple Qs with KWeb, and this is going back 5 years. Yes, no, 10 years. So I'm looking at the spread to narrow, and KWeb is still very low. Baba is breaking out. Alibaba is breaking out. So spread trade between these two, especially with biased on Alibaba, is like one of my trades that I'm still looking at and expecting good returns. This is probably like about a 1 year duration hold. That's about it. That's what's on my mind. That's what I've been looking at, working on this week.
Well, I spoke to Q yesterday, and he was supposed to be on, and he says he is still cautious on China. And I know I also spoke to Tony Lobier, who says he is now out of his China stocks. But that chart that you show reminds me of the chart I was showing, where I was saying, well, you should be buying gold stocks because here you got the Qs, information technology way up on the US side, but
Tyson, I'm not necessarily trying to be a contrarian here, but generally bull markets or reversals of spreads never happen when everyone thinks it will happen. It happens when everyone's cautious. That's the whole point. So maybe like when this spread start really pulling back, then people are going to go optimistic, maybe amplify, accelerate the convergence. But generally, is it a risky trade? Yes, but don't forget, this is a spread trade. This is not like a one-side bet. So you tell me, what are the chances fundamentally and technically that this spread is going to keep on increasing? It might stay here. It might go a little further. You might lose a little money, but the probability that it will go in your direction and the amount of profit you'll make if this convergence even happens at 1/3 of its rate, not the full convergence, that's traditionally called very, very good risk reward. Of course, if you have the belief, this is not just about watching this chart and believing it has to reverse by itself, but there's other factors as well.
Well, these things start to happen incrementally and then they start to feed on themselves. And I think the fundamental case you just laid out is compelling, as is mine, and we'll see whether it happens. Sid, tell us what your thoughts are on gold, and you had written a piece on your website that I thought was very interesting. And go ahead, Sid. You're on mute.
I'm sorry.
No, it's all right.
Yeah, thank you, Tyson. I'd written a blog article about 7-10 years ago about the resurgence of gold and the BRIC countries moving away from the dollar and trying to establish an alternate currency, as well as the dollar's decline. Because the writing is on the wall. The debt that U.S. has accumulated, that cannot be sustained. So, somebody like Trump was elected because of just that, because he promised to bring manufacturing jobs back to the U.S. And that's a huge task. That's a tall task, because that's going to impose short-term pain on all of us. including the inflationary effects. But I think they'll be well off focusing on heavy industry and increasing exports. But by definition, that'll mean that they will have to devalue the dollar, and that will increase the price of gold. And then also in uncertain times, in times of war, a lot of countries have experienced that their assets have been seized by the US, and they simply want to move away from the dollar deposits or the European or the pound just because of that. So they've been stocking on gold. The central banks last year bought about 2,000 tons of gold, and mostly they were China and India. In India, for instance, each family unit of 1.4 billion people, let's say divide by 4, they have approximately 3 to 4 pounds of gold jewelry in each household. That's personal gold. And then there's the gold owned by the central bank. So technically, they are the largest owners of gold in the world. But anyway, and then there's China. So they're really trying to move towards backing their currencies with gold. And then also in that process, the currencies like Bitcoin, they will also take off because of the ease of cross-border movements, the inability of the governments to track where these monies are going. And then for these governments who are at war with each other to be able to use those, Bitcoin type of, alternative currencies. So in the long run, I think gold will continue to rise, and I would not be surprised if in the next 10 years gold will go up to $10,000 an ounce. This year we'll probably end up at $4,000 an ounce. Next year, $5,000 an ounce. And
Saying,
Yeah, sure. Let me get started.
tell us what your thoughts. You've stayed out of the market, and after killing it in November, and you've got a lot of quantitative experience yourself, a real practitioner, trading your own money. Tell us what you got.
All right. Hi, everyone. It's time to update on my quantitative strategy again. So firstly, regarding the portfolio, regrettably, I'm still largely positioned in cash. There was a critical time window where my risk management overlay was in conflict with the signal generated by my individual stock selection system. So to be specific, stocks such as Palantir, Netflix, MicroStrategy, and Uber were qualified as a new buy according to the system criteria.
What were those?
I'll show them on the slide.
Okay.
So using Palantir as an example, it shows initial momentum. And the second step is you need to undergo like 1 week of consolidation. And it finally broke out on significant news when President Trump announced that he was dropping the 145% tariff on China on April 22nd. That's the third step to the system. So my system correctly identified them as potential market leaders. Oh, actually, let me show you the other ones. The other ones are Netflix, MicroStrategy, and the last one is Uber. So, however, the risk management framework, which at the time signaled significant caution due to the unresolved issue mentioned last time, so prevented me from deploying capital into these specific opportunity when they first presented. The last 4 weeks, the broader market underwent a remarkable, quick recovery. The longer term moving average on the indices, which had been a major point of concern, have been repaired. At the same time, volatility as measured by the average true range has materially come down from elevated levels. And most strikingly, the new leadership has clearly emerged, predominantly in the high growth technology names. It's the same group that led the euphoric market rally just a few months ago. So, so the natural question is, why did this recovery materialize with such unexpected speed? I think that there are several factors that converged. So firstly, on the fiscal side, despite the widespread expectation of tightening, it appears that government spending is not going to be materially contract as much as anticipated, providing a underlying support. Secondly, President Trump rolled back many of his tariffs, including the 145% on China. So suggesting that tariffs were just short-term negotiation tools, like not permanent policy changes. So thirdly, there is a powerful undercurrent. Corporate earnings have been surprisingly robust. A significant driver appears to be artificial intelligence, which allow companies to become more efficient and to reduce workforce, boosting margins. So we're in a somewhat paradoxical situation where we hear like mass layoff announcements all the time, while at the same time, companies report stronger than expected earnings. And finally, we cannot ignore the structural change in the market itself. Since the post-2019 market is faster and increasingly influenced by large quantitative funds, it's like pure quantitative giants like Citadel, like Jane Street, and Hudson River Trading, along with like multi-strat funds, heavily rely on quantitative factor models. Firms such as Millennium, like Point72, BAM, and D.E. Shaw have prospered. It's like you see, like on all the 13F filing, these were the prominent funds that are like holding like most of the stocks. Their capacity to analyze data and deploy capital at immense speed and size means that they can accelerate the market moves. So in conclusion, the last few weeks have provided a valuable lesson for me, one that necessitates a clear evolution of my strategy. So the core insight is that I must be like more nimble. So while the disciplined risk management framework remains very important, its application needs to be like more responsive in this modern market. So like market leaders often initiate their recovery before the market does. So waiting for that perfect textbook alignment can mean that missing the most opportune entries into the best performing stocks. So I'll be like more proactive in adding reasonable exposure, perhaps in the 20 to 40% range when the individual stock criteria are met. So this approach allows me to gain initial exposure to the strongest name earlier in their cycle, acknowledging that their tendency to lead. So if the broader market subsequently confirms the positive trend and further de-risk, I can scale into these positions. Conversely, if the broad market falters, the small exposure help to limit potential downside.
Come on.
It's about achieving a better balance between conviction in specific high potential stocks and the inherent uncertainty of the broader market. My focus is now on implementing this refined approach of phased entry into identified market leaders, even if the broader market condition is not crystal clear. That's all I have. I'll pass to Tyson.
Okay, well, Charles, thank you. And as I indicated, yeah, I think this market is, had a huge snapback rally, and some of the events that drove this rebound, were hard to predict. I mean, nobody expected quite the tariff regime we saw or the abrupt reversal. So, for what it's worth, don't kill yourself to think you're going to catch every up and down, and sometimes staying out of the market it may be the right call, and certainly we'll see how it plays out. But
Yeah, absolutely.
Are there any questions? Alan DeLugash, Mike Portnoy, Duncan Riefler, Michael Daly, Scott Osborne, Randy Hughes from our esteemed colleagues. Alan?
Well, and the only thing I was going to say is uh, I've been a fundamentals guy my whole life, and I think that the ability to try to predict future things based on the past, which can't possibly factor in the kind of idiocy coming out of Washington, to think that there's some kind of model or structure that could factor in these kind of things happens doesn't compute in my mind. I mean, people might think that there's a way to do it, and I guess people have been successful at it for a long time. I just can't get my head around trying to think that somehow some model could have predicted anything of what Trump is doing. And he's really running everything. I mean, we've talked about onshoring, we've talked about the tariffs. I mean, even stuff on this phone call, misunderstanding a lot of stuff. We haven't outshored our manufacturing. We're doing more manufacturing today than we've ever done in our history. And to the extent what we've lost is manufacturing employment. Manufacturing employment is down the tubes because of technology. Offshoring was a secondary component. And the only reason we're losing it is because we can't produce it here. So we've got a president, for example, who says, I'm going to do onshoring by using tariffs. The only way you're going to get onshoring, if you even wanted it in this country, was to get rid of the fundamentals that are kicking our stuff offshore. Regulation, high costs, high taxes. We're never going to get that back. If we don't change that, we're never going to get the manufacturing back. One final thing that I just wanted to say on this, because I find it a little bit funny. The people who want to bring manufacturing back to this country, why don't you, it reminds me of the Milton Friedman thing. You know, they're building the dam using shovels instead of big earth moving equipment. And they say, well, we're not using the big earth moving equipment because we want it to be a jobs function. Well, if you want it to be a jobs function, why don't you use spoons instead of shovels? And it's the same argument that we're doing now with trying to onshore manufacturing. Onshore manufacturing became a thing because 95% of the people in this country were working in agriculture. So we finally figured out a way for agriculture to be done so much cheaper that everybody lost their jobs in agriculture and they went into manufacturing. Well, then the next step, we're losing manufacturing, we're going into service. But now people say, Trump says, and other people, we want to get the manufacturing back. Why don't you go to full service? Let's get the agricultural back. Let's go and get everybody, growing their own food. I mean, it's like, I just don't understand. You get somebody like Trump who's getting people to follow him because he's got this energy and this charisma of people want to following him, not realizing that what he's saying is generally pretty dumb.
Yeah, I have a comment. I totally agree with Alan. And it's one thing that I found interesting is like kind of searching for clues, words, what Scott's saying, what this is saying, what not. One thing that came across to me is actually there's really two filters of reality between what needs to be done, what Trump is saying. One is, who is he listening to? And that's like confronting his own people. Like, I don't know, one day he's going to listen to Scott Bassett, another day he's going to listen to another guy and whatnot. And then the second filter of craziness is that what is he going to say at the end of it? He's not even going to say that. He's just going to come up with his own theory that at that moment he just feels, that's the way to go. Well, maybe you built like a real estate empire in Manhattan, like dealing and wheeling kind of street smarts, but I totally agree. I think he can have the best experts and they might figure things really out, but the execution is going to be horrendous. And that's what he's showing right now.
We are pleased to announce that Chang Q, our China expert, has joined the call. Could you give us a quick comment on China? I'm sorry, Mitch, if maybe.
Yeah, sorry, Tyson.
Tyson.
I just
Can
I'm late.
Hey Tyson, it's Duncan. Could I ask a question related to China?
Yes.
So I find that the chart that before really interesting, the spread between China and the US. And then I think something I've been struggling with, somebody on this call was recommending BYD a few months ago.
Right,
And
Tony.
yeah, so it's been a really interesting trade, right? Because it hits on all these themes that there's no way we can out manufacture China on a car. So we're basically the only ones that don't want a Chinese car. Everybody else is going to buy those cars. And BYD's sales are just, going through the roof, even without any US sales. So then the other side, so they've got technology and manufacturing driving that. But then the other side, on the conversation we had earlier, I was hearing about Alibaba, and I'm really curious about the distinction between how a company like Alibaba is valued and what they are bringing and who their revenues come from relative to the Mag 7 type guys that we have in the US. So anyway, I'm just throwing that out there. I'm trying to understand it a little better, and I just thought if I could get that out there in front of your comments, it might be helpful.
No, that's great. There's a very erudite and perspicacious insight and question. And we have just the perfect person to take a first stab at it in Chang Q.
Yeah, sorry, Tyson, just to finish off,
Okay,
just a
Mitch, go ahead.
footnote to Duncan. Today it was really announced that European sales of BYD overpassed Tesla.
Oh, yeah. I know.
That's Europe. The rest of the planet is like there is no Teslas.
Yeah.
Yeah, I think BYD basically in China, wherever the market is, they are gaining market share from Tesla in terms of EV sales. They are cheaper, and the feedback on the ground, people like their cars in a sense. The Alibaba, I think too earlier to answer your question. If you look at Amazon, I think Amazon is very similar to Alibaba. On one hand, they have merchandise sales, and on the other hand, they have Ali Cloud, that's like AWS, and they also have major is their advertising sales. They just like inside their website, they do something like a bidding, just like people basically bid higher, they will have their name on the top for those merchant sellers. So in a sense, Amazon right now have a big advertising revenue. Actually, Alibaba did that even earlier than Amazon in terms of advertising sales. If you compare another thing, compare Amazon with Alibaba. Alibaba is way smaller in terms of Ali Cloud. The cloud contribution is way smaller in terms of percentage of sales and earnings relative to AWS in Amazon.
Yeah, and Duncan, since I mentioned Alibaba, just to attach to what Chang was saying. Yes, their cloud is just small beginning, but the thing is their growth, especially not just in China, but China is greater. And their technology impact, which I mentioned, is just not, its supply and demand side of AI is brilliant. It surpasses Amazon by leaps. So going forward, they have a brighter future than Amazon. I'm not saying Amazon's going down, but they have the growth pattern that Amazon can't reach, never, as Alibaba has. But generally, yeah, Chang is right. It's a very good comparison and very similar to Amazon.
Yeah, I think they are kind of like learning from each other in that sense. For example, a few years ago, you won't see much of advertising revenue from Amazon, but now Amazon advertising is big. That's, I think, they probably learned from Alibaba in that sense. And Alibaba Cloud most likely is learning from AWS in that sense too.
Chang, you were a little cautious on China. And there are people who periodically say, I won't touch it. And, the relationship with the US has clearly gone from being much more tolerant and comfortable.
Yeah. I
Things
think
are changing.
that's a major concern. You see, even yesterday, still some Republican leaders, some senators and congressmen, they propose to delist the China names in U.S. And a few days ago, also there's a Chinese lithium battery company get listed in Hong Kong, and for that IPO, the Chinese company, they specifically they said they don't want the U.S. based investors. So I think that's a troubling troubling act on both sides of in the U.S. side and in the China side. They basically worried about each other in that sense. And also the tariff, even though they rolled back last week, still the existing tariff is still very high, and that in a sense is still not a lot sustainable either. On the good side, I want to say here is in the social media space, there are a lot of rumors that China may, the paramount leader Xi Jinping, he might step down. There is a central government, the Communist Party have a central meeting in August, and right now a lot of those rumors, because he is really the guy who pushed China backward in terms of Mao's policy, in terms of a roll back from the open world policy, and get so the relationship with the U.S. becomes so bad. In a sense, some of his policy was in a sense was the cause. I mean, if he really stepped down or to a secondary role, put somebody else in the front, he is involved less in terms of policy, and role, or the new people from the rumor was more inclined to reform and economic progress. So in that sense, the relation, I hope, with U.S. will be changing for the better. That would be a positive progress. I mean, it would be a positive development.
Sorry, go on. I'm sorry.
That's a 10-year policy view versus a one-day Trump policy view.
Yeah, I mean, Trump is tough in terms of in terms of dealing with the Chinese Communist Party or the leadership there. They feel Trump is tough. Like last time, the Geneva, the negotiations there, some people basically said the China side, they softened their stance in a sense because of partly because of the potential leadership change back in China.
Well, I gotta say, if that happens, that would be huge. And then all we need is Vladimir Putin to step down and the mullahs, and we pretty much got a much higher market guaranteed.
So they basically want in China, they want Deng Xiaoping's policy to get back. They basically said the current leader deviated from Deng Xiaoping's open China policy.
Alan, do you have any thoughts on that? You said you got a brother who's got all these factories over there, and I hear that there have been riots. You're on mute. Go ahead.
Yeah, no, yeah, my brother has a very large organization based in Hong Kong, 12 factories in China, and he's recently, for obvious reasons, has had to open a couple of factories in Myanmar and one in Vietnam to deal with people who don't want to deal with China. But my brother will still tell you, I mean, I totally agree. Getting back to Deng Xiaoping would be a game changer for everybody. But my brother will still tell you that as of today, bar none, that China is the freest economy to manufacture in the world. And so everybody who's moving out of China and the US push to get everything out of China, that's fine. It's just going to cost more money. Forget about onshoring to the US. People may have seen, there was a very interesting article, I think it may have been National Review or the Wall Street Journal, I think National Review, that talked about Adidas, Under Armour, and Nike trying to move some of their sneaker making facilities to the US. And it turned out to be a ridiculous joke. I mean, you can't do it. The price structure is such that it needed to be done by robotics, and sneakers and a lot of other products, but sneakers in particular, cannot be done effectively by robots. Too many different sizes and too many different things that require human skill at the present time. So I think it would be great if this stuff with China would ease up a little bit. I mean, this was all caused by Trump. Just to focus on a point somebody said before, well, tariffs are down to only 10%. 10% tariffs are huge. They're huge. They're a major detriment for the U.S., both inflation and for GDP. Costs are going to go up, and the Trump's moronic application of these tariffs, putting 10% across the board to everybody, including not that balance of trade means anything, because Trump obviously doesn't know what a trade deficit means, but even if it were a relevant thing, it's putting a 10% tariffs on people that we have a trade surplus with. It just, none of it makes any sense. And just to focus on something I've said a million times, Trump has no principles. He's got instincts, and his instincts change based upon the last person that he spoke to. And it's not even the last smart person he spoke to. It's the last person who said that he was a good guy. So it's a very dangerous way to have policy. One other point I just wanted to make, talked about inflation as a potential way to kind of get us out of our debt, our terrible $36 trillion debt. It won't work, because fully almost 2/3 of our debt, much more than the 36 trillion, probably another 60 or 70 trillion of our obligations are not debt. They're obligations to provide future entitlements for Social Security, Medicare, Medicaid, etc. And if we try to just inflation our way out of the existing debt, we'd be screwing ourselves by a lot more in obligations to provide services in the future. So I think we're in a very bad place in this country, that we have unsustainable deficits and unsustainable debt. And we do not have, as a way to get out of it, inflating our way out. So just some thoughts.
Let's try to wrap this up. Are there any burning questions to wrap this up? I got to say that Chang's comment of the idea that Xi Jinping would step down is really very interesting, because it would really have profound impact. And
what impact is that, Tyson?
They basically want to have more kind of like a reformist policies. For example, in terms of open up to the world, the WTO time, China promised a few industries to be opened up, but that's even up to now still not really opened up. Or some, like the financial service, even though U.S. and foreign countries can go there, but once you get to China, they still have a lot of local regulations that make your life very tough, or make your life to get to new customers very tough. So they basically thinks of further open up of China in terms of the original what Deng Xiaoping opened up is gradually China will become an open up a country more aligned with the rest of the world.
Chang, is this rhetoric or can this really happen? Because I'll give you a parallel with you mentioned Putin, Tyson. For a very simple reason, you take Putin now, you'll get a much more hardcore guy on power, 99%. And I kind of think, I might be wrong, that's a question for Chang. I just don't see any rotation at the top in China is going to change much, even at the Politburo, not to mention like local level, which things just don't change for decades. So that's why I think huge, not really, maybe for markets, but reality would check in. I don't think any changes will happen there.
Well,
Chang, any parallel to Russians?
I guess in a sense, that's a lot of people think that way too. I think in a sense, maybe the social media is kind of like they hope that kind of a change, because right now China, if you go to the ground, a lot of sense we are manufacturing, they did well, but it's over capacity. And then the housing market basically a little bit of rebound, but still is over construction over there. And even in the major cities, for example, like Shanghai and Shenzhen, people, a lot of in terms of consumption, people are doing downgrading. It's not like upgrading. So in a sense, the economy is still quite bad. So people want some change, because under Xi, the government-owned enterprise, they are very wasteful, but they are taking most of the resource. They deprived basically the private enterprises opportunities. And also, like under Xi, many of the private enterprise get severely punished. Like Alibaba get a fine like hundreds of billions of renminbi a few years back. And some of the private industry get like a private education, the tutoring get really like banned. So basically, many of the policy under Xi is not really well had very negative results on the economy. So that's what the people hoping to change. Open up and reform. Open up is basically it's not like a fighting wolf with the rest of the world. More getting along better with the Western world. That's on the open up side. On the reform side, basically, give the private enterprise more. Let them have a more playground with relative to the government-owned enterprise. Protect those entrepreneurs or those private company owners. Because right now there are still reports, many people, the private company owner get basically seized up by policemen. They just say, oh, you evaded the tax a few years back, and now you got to pay it, and with a lot of punishment. And some people get fined a lot. So those are the things the reformists want to change.
I want to wrap this up.
Let me just
add
one. Can I add one very quick thing on that? Both in Hong Kong and in China, the tax regime is also out of control. That's especially in Hong Kong. They have the taxing authorities are extremely dictatorial. They don't obey the rule of law. It's very difficult from a tax perspective to do business, and they just drag on things for decades. My brother's got a case that he should have been an easy winner, but it's still outstanding from 2000. And Hong Kong won't move forward on it because they don't know what to do, but they don't want to let it go. One final thing, my brother also says that over the last year or so, the change has happened. The one-child policy has been biting. He's got more people retiring than new people coming in. It's a first, and it's only going to get much worse.
Well, in China now they've changed the one-child policy to two kids per family, and not only that, if they bring in reforms, I mean.
But by the way, that's not working. It's not.
No, I know, but the way they could dig themselves out of a recession is, and not only that, I mean, they really don't have to depend on exports only. Even with the recession now in place, they still have a 5% growth, which is almost double the Western world, number one. And number two, they can go into a consumption mode. I mean, that's how US and all these Western countries from the 50s, we had the go-go 50s and we had so much prosperity and we became consumption economies. I mean, they can just stimulate their own economies. They can cut the interest rates, and they have 1.2 billion people. Same thing in India. I mean, they really don't need to look outwards. They can look inwards and promote their own industry. And not only that, they can free float their currency. The real value of the currency is the Chinese renminbi is almost three to a dollar. Right now it's at 7 because they artificially control the exchange rate. Same thing in India. It should be like 40 rupees to a dollar, and they're at 85 because they want to be able to export to the US. So all these countries, they're selling their souls, and the people are working at half the wages or 1/10 the wages of what they would get paid in the Western world. And so, these countries, I mean, they can definitely change. And the tax regimes and all of that, that's because of corruption. They want monies. They want to extract the most monies. That happens in India also. And it's the same problem in China. So, yeah, if these people, they turn around and, India has like 7% growth rate. That's huge,
Well, wait a minute. Let's get these growth. First of all, in China, the 5% growth rate is probably totally bogus. But even if it weren't, when you have a country like China or India, let's understand something. You can't compare that growth rate with the growth rate of a developed country, because when you're still taking spoons into shovels and shovels into backhoes, that will automatically give you growth, not because there's actual growth, but just because you're just trying to catch up with minimal technology to the rest of the world. So a 5% growth rate in China, even if it was real, basically is terrible. It's like no growth at all. That's just moving into the modern world, you get that. So
yeah, but look at the opportunity. See, in the US, an average household with 2 kids, 2 adult kids, we have 4 cars, right? We have 2 refrigerators. We have 20 pairs of shoes, 20 pairs of suits, 40 shirts. In India and China, they want one of everything. Not only that, one of everything, they want 5 of everything. In India, every household, maybe 1/100th of households have 1 car each. So imagine if each household wanted 4 cars each, especially with the electrification, they don't have to depend on gas. They don't have to pay higher prices, right? I mean, they have so much needs. Every household needs a refrigerator. Every household needs an air conditioner. All the things that we've had in the US and the Western world since the 50s, they need 1 of each or 2 of each or 5 of each.
But
there's so much opportunity.
But they're not going to get it, because the reason they don't have it is because government policy and the culture makes it impossible. And saying that they need it is not going to get it to them absent a major change in the way the government treats its people. So it's because we've been saying that for 20 years. In fact, India, for one, was on the way towards that improvement, and then it just basically stopped over the last 10 years. It's if the culture doesn't change, that growth you're looking at, even though it's there potentially, won't happen.
No, Alan. So that's what I'm saying. The culture does need to change. However, let me correct you in the case of India. In the last 10 years, under Mr. Modi's government, the Indian economy is now the number 3 largest economy in the world. Okay, US is number 1 because of the higher value of the dollar than China, and then India, then Germany is next, Japan, or maybe California. So that's how it goes. So if you looked at the purchasing power parity of the dollar, China would be number 1, India would be number 2, US would be number 3. Now that's a hard pill to swallow, but that's the reality. India has 1.5 billion people, 40% are under the age of 30. They have so many young people who are willing and able to go out, to speak English, highly educated population. They have the sky is the limit. They're building new cities, they're building new plants. Apple is moving all their production to India. There'll be so many companies that are, China plus one policy is going to help India a lot. Not only that, their own indigenous development is so big and so huge that they're going to be the world's number 2, number 1 economy, by 2030.
Okay.
Go ahead, Alan.
My argument is just that all of that is irrelevant. If you're not talking, just because they've got a gazillion people, but it's on a per capita basis, there nothing is going on. And the reason India surpassed China solely has to do with population and nothing to do with anything else, really. So again, we'll see where things take us, but that's all I have.
I want to wrap this
Yeah,
up.
let's just add one point here, relative to the earlier speaker. The China, in a sense, if going with the PPP, okay, renminbi maybe is undervalued, but on the other hand, because of the current policy, if you really open the currency control, you don't control currency, my bet is renminbi will go down before it goes up. What happened is most of the rich people, they don't feel safe back in China. So if there is an opportunity, they want their money out. So that's the problem. That's why the reformists, they want to reform China, make people more comfortable to, or maybe make the policy more friendly to those entrepreneurs and the private companies.
That's a good point.
Thank you, everyone. Obviously, we got onto some interesting topics and look forward to speaking to everyone next month.
Thank you, Tyson.
All right, take
Okay,
care, everyone.
thank you.
Bye-bye.